I'm Rick Kaler. Thanks for joining me. Last week, we looked at 4 types of stinking thinking. Those are cognitive biases that can contribute to poor investment decisions. Here are the next 6. The first for this week is Monte Carlo fallacy. This fallacy is placing too much emphasis on the likelihood of an event happening just because it hasn't happened recently. Think of the last 13 years of rise in the stock market. Many investors started betting that stocks would crash after rising for 4 or 5 or 10 or 12. Yet that history is statistically meaningless. The odds of a stock market going up or down every year are about the same, regardless of what has happened in previous years. Overconfidence is another one. This is big. Many people feel that they have information or research that's so good, they know what's coming next. As a professional investment advisor, I experience this from time to time when a client values their gut feeling above any of the empirical data or years of education their investment advisor might offer. One recent example I can think of overconfidence bias was those who knew the stock markets would go down immediately if Joe Biden won the 2020 election. Instead, the market had the second highest advance in history. Confirmation bias, and this is the tendency, and we see this all the time, to only look for data, instances, or research that confirms what we already know is true. We're certain it's true. So if you were convinced that markets would crash if Joe Biden were elected president, then you would have looked for information that agreed with that position. And you would have found plenty of reinforcement. It would serve us much better in such cases to look for information that contradicts our firmly held beliefs. This might result in adopting a more thoughtful and balanced decision. Next, loss aversion, and this is simply placing more emphasis on avoiding loss than the possibility of gain. It results in investors wanting to kind of have their cake and eat it too by searching for an investment with a high return and low to no risk. Such investments don't exist. When they discover this, many people don't invest at all. Others go into an investment expecting it won't go down, then sell out at precisely the wrong time when it does. I've noticed over the years that it's far easier to have a low tolerance for risk when an investment's going up than when it's going down. Then all of a sudden, a person can have a high tolerance for risk when it's going up, and then a low tolerance for risk when it's going down. Yeah, I'm perfectly okay with 100% of my portfolio being in Facebook and it's going up. But when it goes down, OMG. So that's called loss aversion. Delusion, this is an attitude that bad things only happen to others, but not me. A deluded investor is somebody that holds on to an investment even when it's apparent that it's never coming back. And there's all sorts of examples of that in history. I mean, I remember of me who bought Kmart stock for 50 cents a share because it was like, I don't know what it was down from, $50, $100 or something. And I think they had filed for Chapter 11 bankruptcy. Yeah, well, they wiped out all the shareholders in the Chapter 11. So it's kind of like, what didn't I get about that it wasn't coming back, right? Narrow framing. This is making a quick decision without gathering or being aware of all the facts and considering the implications of everything. Usually the investor doesn't uncover the rest of the story. until it's too late and the financial damage is done. So the study of cognitive bias as it applies to investments, it's something that's called behavioral finance, which explores the effects of psychology on investors and financial markets. This is quite different from financial therapy, which goes deeper to understand and resolve an individual's personal history and trauma that causes the cognitive bias. Making rational investment decisions requires not only the ability to process our own emotional impulses, but the knowledge and imagination to anticipate consequences. During a stock market decline, those who sell out focus on relief from anxiety that it might bring. Those who stay in or increase their investments may have the same initial impulse, yet they override it by first using their left brain to access the knowledge that market cycles are normal. Next, they switch to the right brain to imagine the anxiety that would come with missing out on gains when the market does recover. All of us have cognitive biases that affect our financial decisions. Understanding that most of us make financial decisions that are not in our best interests is a really good first step toward learning to make them to positively impact our financial well-being. Thanks for joining me.